What's up, y'all? Attorney Tom here. I'm going to be starting a series about things that they should teach you in school but don't. And the very first subject of that series is going to be real estate transactions. I'm going to make multiple videos starting from the very beginning of the real estate buying process to the very end, with the goal of providing you enough information where you don't have to pay a jerk-off lawyer like myself tens or hundreds of thousands of dollars to come in and fix your problems, or even worse, get you out of jail. But before we get into it, we've been growing like crazy, y'all. We just hit 110,000 subscribers. Make sure you hit that like button and subscribe to the channel if you want to be a part of this community. Your appreciation and your support really means the world to me. Okay, let's start from the beginning. You've just decided you're in the market for real estate. Well, before you go out and find a house or commercial property that you like, you probably want to get pre-approved for a mortgage. That's because unless you're paying in cash or doing a seller financing deal, which would need to be its own complete video, the way you would afford the property is through some form of mortgage. And the last thing you want to have happen is you find a piece of property that you like, you negotiate a deal that you like, and then you fail to get approved for a mortgage. That's why it's important to get pre-approved for a mortgage. And notice how I said pre-approved, not pre-qualified. That's because there's a difference. Essentially, a pre-qualification is like a test run. You give the mortgage lender some very basic information. They don't verify anything, and they give you an estimate of what the loans you should qualify for, but that is not guaranteed. Where in contrast, getting pre-approved for a mortgage is essentially an offer letter from the lender saying that they will lend to you at the pre-approved rates in the deal. But in order to get pre-approved for a mortgage, you're going to have to turn over all the paperwork as if you had already struck a deal and are going about getting a mortgage in the traditional sense. So now you're deciding to get pre-approved or not, you're just looking for a mortgage in general. What do? Well, the first step is you're going to need to pull your credit score. Now, generally, mortgage lenders are going to want to lend to somebody with a higher than a 740, 750 credit score. If you have a lower credit score, it is still possible to get a mortgage, but you run the risk of getting a subprime mortgage, which is essentially a mortgage that accounts for the risk factor of you defaulting. So you will be paying a higher interest rate. Now, while there are good programs for individuals with lower credit scores, such as the FHA loan, which I'm going to get to in a second, for the most part, I would recommend avoiding subprime loans if possible. Next, now that you have your credit score, what are you going to do? Well, you're going to check that credit score, and you're going to look for any inaccuracies in it. If you find any inaccuracies, go and talk to a credit expert. I'm obviously biased. I think you should probably talk to a lawyer and get your credit disputed. Now, warning, there are a whole bunch of credit gurus floating around the internet that aren't lawyers and are presumably cheaper than lawyers who claim that they can fix your credit. But I often see these gurus as making fake promises that are unrealistic and cannot follow through on what they say. I recommend talking to a lawyer on this. They'll set your expectations correctly, and they have the authority or the leverage to actually do something about your credit score if in fact there's a meritorious dispute that you can make. Now that you have your credit score all figured out, the next thing you're going to want to do is calculate your debt to income ratio, because this is something that mortgage companies look at when you're buying real estate. Generally, mortgage companies are going to want to lend to people who have a 35% or less debt to income ratio. What a debt to income ratio is you take your gross income every month and you compare it to how much debt you have every month. So if you think about it, that makes sense. They don't want to lend to somebody who's making $100 and then spending $100 just to pay off their debts. They want people who are presumably going to pay off the new mortgage. And where this really comes into play is the price of the property that you want to buy. Obviously, more expensive properties have higher monthly mortgages, which would affect your debt to income ratio. So in your own head, if you calculate your own debt to income ratio at around 35% and work backwards, you can kind of figure out what price range you're working with respect to what you can afford. Next, you're going to need to gather a whole bunch of documentation. Your social security number, your employment history, your tax history, your current address, probably a list of people who they can call and verify and vouch that everything you've stated in your application is true. And if you're self-employed like me, getting a mortgage is a total pain in the ass. My employees have a better chance of qualifying for a mortgage than I do. Or at least that's how it feels. And the final step in the mortgage pre-approval process. You got your credit score. You got any inaccuracies fixed. You submitted a whole bunch of documentation. Well, you're going to do it again. You're going to go to multiple lenders. You're going to shop around because you're going to try to get the best rate possible. And remember, when you're dealing with such a large purchase, such as a house or a commercial property, 1% in interest can save you tens of thousands of dollars. So you're going to probably go shop around from 2, 3, 4, or 5 lenders. Now, full disclosure, if you shop around with a lot of vendors, they do something on your credit report called a hard inquiry, which if you get too many of them, it could very well ding your credit score, but that's why you have a good credit score going into it. And also, FICO has given guidance that if you are doing this, they suggest you doing it in a small amount of time. They suggest do all your inquiries within 30 days. That is to best preserve your credit report. But again, this is why you have good credit, is for this situation. This is the reason why you have credit, is for a mortgage. Next, let's talk about FHA loans. And I want to do this for a couple reasons. First, it's a pretty good deal. Second, mortgage fraud. What is an FHA loan? An FHA loan is a mortgage insured by the Federal Housing Authority. And with an FHA loan, the borrower only has to put 3.5% down on the property and can qualify with a credit score of 580 or higher. And obviously, as you can imagine, these loans are really popular with first-time home buyers. But there are some regulations that come with FHA loans. Specifically, the FHA loan borrower must use that real estate as their primary residence for at least a year. And I see a lot of these real estate gurus on the internet bragging about committing mortgage fraud by using FHA loans. Let me give you an example.
People who really should not be giving any advice, especially when it comes to buying houses. Actually, a really popular TikToker, cute little video. She's like in the snow with her son and they're pointing to stuff and they're like, just bought a second home in the mountains. Here's how I'm gonna cash flow it. I'm gonna rent it out 90% of the time, put 3.5% down. Here's my expenses, here's my projected rent, and then it's her and her son dancing. We're gonna make so much money. She's committing mortgage fraud. If you guys see something and then you call me and I'm like, it doesn't exist, probably believe me, the lender, not the rando on TikTok hopping in the snow bragging about mortgage fraud.
Now, the video I showed you was an example of mortgage fraud from a very trustworthy source, Jennifer. Go check her out. But I decided to show her video rather than the original posters because I don't want to make anybody go to jail or give somebody unnecessary attention to go to jail because they're basically bragging about committing mortgage fraud. But why are they committing mortgage fraud? Well, if you notice from the video, she's bragging about how she put 3.5% down and she's going to rent out the property 90% of the time. Well, she's breaking the FHA loan violation in which borrowers have to be primary residents of the property for at least a year. Don't do what the TikToker was doing. That is mortgage fraud. Speaking of mortgage fraud, let's talk about other types of mortgage fraud. Mortgage fraud schemes usually involve a material misrepresentation, misstatement, or omission of facts relating to the property that the lender or the insured relies upon when granting the mortgage. And according to the federal government, 80% of mortgage fraud schemes usually involve some sort of insider, such as an appraiser or underwriter, in order to basically steal equity out of a real estate transaction. Let's go over the common types of mortgage fraud schemes. Air loans. Mortgages obtained by a lender for a fictitious property or borrower. Basically, the lender is fabricating a mortgage out of nowhere so they can keep the money, and they make payments on it for a while to keep the ruse going. Equity skimming. It's essentially when a homeowner is in foreclosure or near foreclosure and a scammer comes and approaches the homeowner and says, hey, listen, I can refinance your house, save you from foreclosure. All you have to do is transfer the title to me and I will refinance it. Well, what ends up happening is the scammer takes the equity out of the house, refinances the house, leaves the homeowner with essentially a second mortgage and no equity. Identity theft. That's as easy as it sounds. Somebody steals somebody's identity to obtain a mortgage. Inflated appraisals. This is when an appraiser colludes with the borrower to inflate the value of a property so they can get more money from the mortgage. Misrepresentation of assets or income. This is when somebody lies on their mortgage application and says that they make more than they do or they have more collateral than they do. So be truthful when you're filling out your mortgage application. Occupancy fraud. This is when a borrower takes out a mortgage on behalf of somebody else. And finally, my favorite mortgage fraud scheme, which I cannot prove, but I wouldn't be surprised if some of these YouTube gurus were committing house flipping. Essentially, what property flipping is a conspiracy of individuals or companies to get together, corroborate, and artificially inflate the price of a property by systematically buying the same property over and over again at a higher price in order to reap the benefits of the refinancing of the mortgage or the new mortgage. And obviously you can see how this is a problem for the victim lenders who write these mortgages thinking it's a true sale of somebody just trying to make an honest living by really flipping houses, but it's really just an artificially increase of a house that's not worth near what the market value is. All right, that's pretty much it. Thank you guys so much for watching this video. I wanted to start with the education because obviously I think home ownership or getting a mortgage is a daunting process and there's not a whole lot of education about it. And then I kind of took a turn for the worse and I wanted to explain to you that mortgage fraud is real, it's prosecuted. There's a whole subset of criminal defense lawyers dedicated to mortgage fraud, so I am trying to help you avoid them. And a lot of innocent people inadvertently get wrapped up in mortgage fraud because let's just say that you are looking to buy a house and you go and consult with a corrupt appraiser and he tells you that a house is really worth a certain value and you believe him and you really want the house, and then you buy the house but it's been involved in a flipping scheme and you're the one holding the very end of the scheme when the house of cards collapse, and then boom, you're charged with mortgage fraud. So be on the lookout for these kind of things. So yeah, those are my 2 cents. Now that you have a mortgage secured, the next video is going to be about house hunting, real estate agents, what they do, how they get paid, are they on your side, all those kind of things. Okay, that's it for today's video. Thank y'all so much for watching. I'll see you next time.